Good morning, everyone, and welcome to the 6th episode of this series of webinars, which is Crystal Clear Complex Cases. Don't know where you are, but the sun is shining, the kids are back at school, the roads are busier, the cities are busier, and life seems to be returning back to what we used to know as normal. So first and foremost, thank you very much for joining. For those of you that are returning, welcome back. But for those of you that are new to this series, hopefully you've came here for a reason. I imagine it'd be John McCaffery, and hopefully you find this episode useful. Before I make an introduction, I will just briefly mention what we will be doing today on this episode. So first and foremost, there's no set agenda. What we discuss is essentially what you want to discuss. So ultimately, if you've got a question for myself, for Rog, for John, for the three of us, whether it's tax related, product related in terms of lending, any question you've got, please do ask away. It's very interactive, and you shape these sessions and you make them as good as interactive as they are. Okay, so we've got an hour and we're going to have a good day, gents. So first and foremost, I'll make the introductions. As I imagine all of you already know, we've got Roger Morris, which is Group Distribution Director for One Savings Bank. So good morning, Rog.
Morning, Dan. Morning, guys. Morning, John. I think we are set for an incredible session. I've seen some of the questions we come through, and I have to admit, we have got some incredible questions for you today. But as Dan said, and as we just said in the chat facility, Dave's just put in, guys, this is your session. So any questions you want to ask live, we'll make a mixture of live questions and the highest record number of other questions. So it really goes to show that the value that this event brings and the way that it brings it together. And I think that really underpins, Dan, what Crystal's doing and what you've created has to really prove that you're right on the money. So a real compliment to you, Dan, that education, knowledge and value is right at the heart of what Crystal does. So well done to you for this.
Thank you. And yeah, do you know what? It's all three of us that have put this together. I mean, John is the show pony in this and the star of the series, so to speak. But it's all about education. If you want to come on these webinars and get a foundation of knowledge from the likes of John, yourself, and even me, brilliant. If you want to send us cases off the back of it, amazing. If not, that's down to you. It's more about educating the broker market and giving back and everyone learning together. Because again, myself and you, Rog, we learn lots and lots on these webinars with John because he is a tax wizard. So without further ado, as I mentioned there, most of you will know John as the wizard of the taxing world. And we've got John McCaffery, who is a tax partner at Alexander & Co. Good morning, John.
Good morning, Dan. You well?
I'm good. Are you?
I'm not bad at all, thank you very much. Not bad at all.
Good. Thank you for coming on. And yeah, let's kick off. So we do have a lot of pre-asked questions, so to speak. So we'll not start off with how are you doing, what have you been up to, that sort of stuff, because we don't have time for it. We really don't. We've got a list of questions coming in, so we'll do our best to answer the ones that have been pre-asked. So we'll try and get through all of them. Now, Macaulay, you sent us a lot of questions, so we'll do our best to answer as much of them as possible. But if not, we will pick them up after this webinar. Okay. Now, if you do have any live questions, so if what we're discussing is thought-provoking and you've got something you want to ask, then please do. It's like you say, the more questions you ask, the better this episode is, and the more knowledge we all gain. Sound all right, guys?
Yeah, definitely.
Perfect. Do you know what? First and foremost, how have you found it since September started? Since the kids went back, have you seen a pickup in business? Because I know a lot of people throughout the summer found it quieter. People were recharging, going on holiday. Would you say you've seen an increase in activity? And as I mentioned at the beginning, in terms of things shaping back to normal.
Yes. I've been busy throughout the last 18 months or so. Well, I've been busy before, but it got particularly busy. There was a little drop off over the summer. I have to say the stamp duty holiday is still pushing stuff through, even though it's halved. And there are other areas kicking through. So there are a lot of property landlords who are now considering inheritance tax planning. There are people wanting to move on businesses. So yeah, no, it's definitely, and a lot of trust planning. People wanting to inheritance tax plan through trusts. So yes, definite uptake of business has happened.
Good. And what about yourself, Rog, for your group?
Yeah, what I would say is we're getting more and more complex cases, that the world has created complex cases. I mean, Derek Compton, who put one of the questions into one answer now, is just on about how lenders are making customers appear to be complex when in reality they're not. And I think it's just about the market itself will change and it'll diversify, and complex will become the norm of the future. And I think that's where we get the value. When we start now to dig into some of these questions, we'll be able to realize the value that brokers offer and the level of knowledge that they need to have, Dan. And that's why Crystal will become a much more symbiotic partner in the future.
Yeah, no, absolutely. Absolutely. Brilliant. Right, let's jump into the first question. So, Macaulay, we'll go with a couple of yours first because there's some really good questions in there. The first question, which essentially is for you, John. Is it better to purchase a property with the intent to use as a buy-to-let, or better to purchase a property as a home for yourself and then converting to a buy-to-let at a later date?
Dan, can I take this first? Because I think this would seamlessly pass into John. John, do you agree?
That's absolutely fine by me.
I'll tell you why, because Macaulay has actually come up with today is basically first-time buyer, first-time landlord. Now, I know from all the desks that I interact with, the most commonly asked, I would say number one criteria question is first-time buyer, first-time landlord. So what you then do is you source the list table of lenders that will do first-time buyer, first-time landlord. And then you default to finding which offers the cheapest rate. So you've got the lenders that will do it and you come up with the cheapest rate. But at that point is where you make that first, I think, critical mistake, because by sourcing it on total to pay, you're actually in effect giving tax advice without considering a limited company option. And the consequences of this is if somebody is buying their first buy-to-let and they are going to own it for the rest of their life, it's going to form their long-term planning for their pension. When they return in, say, 12 months' time, logically to purchase their first residential will in effect be their second property. They lose that first-time buyer allowance, and they therefore have to pay that 3% extra stamp duty on that second purchase. And unless you've documented by, this is the list of lenders that can do first-time buyer, first-time landlord, by selecting one of the two lenders that technically come top of the survey of our big 5 lenders, do not do limited companies, means that will have the consequence of that extra stamp duty on the residential purchase. And I know that these cases have been referred to the Ombudsman, and the Ombudsman is making the broker liable for that extra stamp duty because it was tax advice. And that's why it's so important that that question is referred to someone like John McCaffery. So John, seamless transition to you.
Seamless transition. To me, and this is how I deal with my clients, this isn't necessarily just a tax question. Do you do a buy-to-let property or do you do a home? Well, it depends what you want to do with your life, really, to be honest. If you are looking for your home, as Roger alluded to there are a bunch of reliefs available for first-time buyers of their own property. Okay, so first-time buyers get a relief from stamp duty. Your first property is free from the 3% additional stamp duty charge. If you want a buy-to-let and you know you're going to buy your own home, then to get the benefits of that stamp duty on your own home, you do need to have that property in a limited company. It cannot be a property you own personally, but you can own it through a limited company. If you're happy renting or living with your mum and dad or something similar, and you want to put your money into a property as an investment, then you're buying a buy-to-let, and you wouldn't get the benefit of you wouldn't pay the additional 3% stamp duty, but you wouldn't get the benefit of being a first-time buyer because one of the conditions is that you have to live in the property. So it's all very much based, as with all my clients and all my advice, on the circumstances that are presented to me. Now, if you buy a property and later want to buy your own residence, you can transfer your first property to a limited company. But remember, at that point, there will be stamp duty in the limited company and potentially a capital gains charge.
Perfect. Perfect. And hopefully that covers that off. I mean, just for me, I suppose it depends really, doesn't it? As you say, because every client's different and it's not one size fits all, which is a few points that came up in the questions that are being pre-asked. And realistically, I know we mentioned before this, in my personal experience, if you're going to buy a buy-to-let and you're going to buy a residential, 9 times out of 10, the residential is going to be more expensive than the buy-to-let, isn't it? So again, there's no one size fits all, but speak to a tax advisor and make sure they are suitably qualified, because disclaimer time, I didn't mention this previously, both myself and Rog, we are not suitably qualified to give tax advice. So if we are speaking around tax, then it's just our opinions and views, and it's not affiliated with Crystals and the One Saving Bank Group.
Yeah, and what we are suggesting is, Dan, is you file documents, first time buyer, first time landlord, that you're not giving tax advice, and the fact that buying in personal names will trigger that 3% if they come back for a future residential. It's just good file conducting. So thank you for that, John. What was the, you were going to do one more question, weren't you, from Macaulay? You were going to ask one more before we went to someone else's questions, Dan?
Yeah, so I'll ask one more. Is it better to purchase a property, introduce this into an existing limited company, or inject the funds and then let the company purchase the property?
Okay. I'm assuming that this is the direct purchase of the property. If you purchase property yourself and introduce it, you've got 2 stamp duty charges, one when you purchase and one when the company purchases. So by and large, it's better to introduce funds to the limited company, and you generally would introduce the funds as a loan, because you can then draw that out tax-free in the future. But this is purely from a tax planning point of view. So other people, lenders, might want you to put it in as capital, which means shares. And if you're going for lending, I imagine you chaps are probably better qualified to comment on this, but if there is a loan from the directors, then the mortgage lender would probably want further security to put yours much further down the line. That said, and alluding back to the circumstances I just described before, if you want to buy your own home, then you most definitely buy that in your own name. And if that later becomes a buy-to-let, then you may want to introduce it to a limited company at that point. But generally, if you're going to purchase a buy-to-let property in a company, you do it directly into the company.
So let me answer a couple of points on that. So often we get asked when arranging finance for a limited company, the accountant has suggested that the trading business buys the property in that trading business. Now, InterBay Commercial will happily lend to trading businesses. There's not a problem on that, but it is a restricted market, Dan, and I'll let you answer sort of the questions of lenders that will do for trading businesses. If you did it to an SPV, you'd have about 26, 28 lenders. So it's a wider offering, more choice, and in effect, a better selection of rates. What we will do within our group, so Precise, Kent and InterBay, is allow an intercompany loan. So let's say we had Roger and Dan electrical trading and Roger and Dan SPV. The HMRC set every January what an intercompany loan needs to have an interest rate set at, which at the moment, John, I think it's 2.25 set in April this year. And there needs to be a proper agreement between the trading business and a limited company. And within that, it sets that interest rate tariff to 2.25. Doesn't have to be a monthly repayment. In effect, it's negative if there is, though I wouldn't give any advice whether there should or shouldn't be, because if there is a monthly payment, it has to go into the ICR calculation because it's a loan repayment. Most intercompany loans don't have a monthly repayment. And as long as there's a mirroring of shareholders, Dan and Roger trading business, Dan and Roger SPV, we're very happy that to be introduced as a director's loan. And we see that more and more common. A lot of accountants will go, you can't do an intercompany loan. We never heard of it. and not being done. And that's the difference maybe between having someone like John and John's firm that would absolutely understand that, and maybe having a small firm of accountants that unfortunately aren't aware of that one. And then the other point I'd just like to pick up on, remember, if you purchase a property as a residential and you convert it to a buy-to-let, first of all, you need to make sure you've got the right permissions as a mortgage advisor to refinance that. We had 2 brokers this week who tried to do remortgage from resi to buy-to-let, and they didn't have the FCA permissions to do a regulated buy-to-let. So not all buy-to-let lenders will allow it, because it wasn't a conscious buy-to-let. In effect, they'd lived there, so it makes it a regulated buy-to-let. So you've got a much restricted set of lenders. Dan, anything for you to add on that one, or John to come back on?
I've got a few points I can come back on, but if you want to go first, Dan, I don't mind.
No, you can
Yeah,
come
sure.
back. I'll finish it off.
Just to prove that Roger shouldn't give tax advice. So the official rate of interest relates to something called benefits in kind.
Right.
Right. Now, that is where a director borrows from the company.
Yeah.
If you're doing company to company loans,
Yeah.
there's more flexibility on what rate of interest you can charge.
Right.
Right. The taxman generally likes it to be at a market rate,
Which is 2.25 at the moment.
No, that's the official rate of HMRC interest.
Right.
Right. So if you borrow from a company as an individual and you don't pay at least 2.25% interest,
Yeah.
you will have an element of that interest added to your salary.
Right. So it's advantageous for a company to company loan to be at least 2.25.
It's between company to company. There are circumstances in which it can be 0, and there are other circumstances in which you actually may want to make it higher. It's a really complicated area, and I wouldn't be doing you a service by trying to give you a short answer now.
Right.
But basically, company to company lending is easier. And I would actually say, don't do the circumstance where, as a director, you borrow from one company personally and inject into another company. That can lead to some pretty significant tax charges.
Yeah.
So you can take your trading company and you can make a loan from your trading company to your property company.
Yeah.
Right. That said, the loan in your trading company is deemed to be what's called an investment asset.
Yeah.
And it can change the status of your company for
Yes.
capital gains purposes, from trading to investment.
Yeah.
And inheritance tax purposes. Now, for inheritance tax purposes, the value of that loan would have to be roughly over half of the value of the company.
Right.
Right.
So, yeah.
So if you're going to finance a property purchase from your existing trading company, you really, I don't try and push this too much. You really do need to take tax advice, because it's very specific to individual circumstances.
Yeah. So our policy is, with our 3 brands, John, is it's company to company loan.
Yeah.
And we'd normally expect to see an interest rate set by the revenue at 2.25%. However, if we did get a covering letter from the tax advisor explaining why it was different, we would accept that, but we wouldn't just ordinarily accept. We would be looking for an interest rate to be charged.
Yeah.
We're not looking from a loan from an individual. But again, this is the difference between lender criteria, which takes a generalistic view, and specific tax advice, but it can be done, and it is a common way of money being lent from one business to another. Yeah.
Correct. Yeah, absolutely.
Perfect, thank you. Do you know, I've got nothing further to add on that. So I think we've covered off that question very well. As always, John, so thank you very much. And I think we shall move on to the next question. So more of one for, I suppose, Roger and me, really, but John, you always chip in as you do. So John Green, thank you very much for this question. What is the future of lending over the next 2 years? So I suppose, what's your view on lending, Rog? Borrowers, lenders, whatever, however you want to take that question.
Yeah, I think if we take the southeast of England, which apparently has a bit of a housing crisis in supply and affordability, one option is, Dan, move to Teesside, where we both have come from and live. But if you actually look genuinely where we see 95% mortgages, it's really just for the elite, for the few. If you're a first-time buyer, and let's just say your first house is 400 grand, and the average first-time buyers are normally a couple living together with 44 grand's worth of income, a 95% mortgage is just impossible because of one factor, affordability. And therefore, affordability is just going to restrict them from ever getting a 95% mortgage. So lenders like Precise Mortgages and Kent Reliance will have a much more pragmatic view to affordability. So we don't do these monthly expenditure forms. It's done off ONS data, and the customer will be able to have a maximum loan amount. So the shortfall in a deposit can be done either with a government help to buy loan, which we do know is going to go in 2023, or the one that's growing fast is shared ownership. And with Kent Reliance, that will be 100% of the share. And then you can do staircasing as your income goes up. And then when it comes to complex things like buy-to-let and other parts of the market, HMOs, semi-commercial, commercial, the market's going to evolve. But as brokers, Dan, complex will become the new norm.
Yeah, no, thank you. And I agree, because obviously we're at the back end of this pandemic, hopefully anyway. And I think adverse credit is going to be trendy. I do think more and more people are going to have adverse credit off the back of it, because we've had a tough time. We've discussed this in the previous episodes, but the UK, well, the world has had a tough time, and more people are struggling financially because people live just within the means the majority of the time. And if you put furlough in the equation, 80% income, yes, you're not doing as many things you used to do previously outside of home, but people can't manage on 80%. So they've missed credit card payments, they've missed mortgage payments, the default on loans. So I think more and more clients, when they're coming to move property, remortgage, take money out for debt consolidation, whatever that is, are going to be, well, not attracted to the high street. So they're going to come to the likes of the lenders that you cover, or even the more subprime lenders in the market, because adverse credit, unfortunately, is going to be a thing which we're going to have to deal with over the next few years. But the solution's out there for everyone, as we know. As long as the loan to value makes sense and there's a justifiable reason for it, and we're going to put them in a better position financially, then a lot of the time in this specialist market, it's a common sense lending. It's not tick boxes like the bigger banks who literally just want the vanilla of the vanilla. There's lenders out there for everyone, but more and more people are going to have adverse credit. Absolutely. And I think, go on.
No, absolutely.
Absolutely. I thought you were going to say something then. It looked like you froze. I think more and more clients are going to look to diversify the portfolios into holiday lets, because I don't think we've seen the end of the staycation, certainly not for the next few years. If you look at the figures for this year, it's an all-time high of people staycationing in the UK. And actually, do you know what? People have realised Devon, Cornwall, Wales, the Lake Districts, the North East, wherever, we've actually got some beautiful places within our country, which people now want to explore. So I think, as we've seen, more and more lenders are going into the holiday let market because they can see that there's more demand there. So I do think that's the way the markets are going. But for me, the biggest thing, and the biggest thing that we're seeing, is the bridging war that's on at the moment. So there's so many new lenders within the bridging market now, and there's so many lenders that are driving rates down. So bridging is essentially at an all-time low. More and more lenders are doing it. The market's more and more competitive, but the best thing about that is actually more and more brokers are doing it. So historically, you'd be looking at 10% of the brokers in the UK used to do bridging finance. I think now that figure's at least doubled, because now people are looking to diversify their income streams from just standard vanilla and residential buy-to-lets to actually look at doing your semi-commercials with, say, InterBay or your bridging or your development finance. And I think it's really complementing the brokers' toolkit, but actually it's allowing us to do more business with these brokers who would have never previously had a need to interact with us, if that makes sense. So I think the market, and I think brokers especially, are diversifying their income.
John, you guys, when it comes to bridging, are excellent, because if you've never done bridging before, you'll handhold them all the way through. and both Precise and InterBay's bridging proposition within 6 months will be absolutely changed completely, adding, you know, moving to what the market really needs. But you guys have always led the market on bridging.
Look, on bridging, I can't say it's regulated for obvious reasons, but on non-regulated bridging, we won't be beaten. Compliance. We won't be beaten. So if you send us a legitimate quote from any lender in the market, and I must stress legitimate, and you say, Dan, pay me more, Dan, get me a better rate, whatever that is, as long as I've got legitimate terms, this business will always beat them terms. We've never been beaten. If our MD, Joe Breeding, gets beaten on a bridging deal, we'd never see him again because he'd be that upset. It's very close to our heart. And like you say, we've got some great relationships with the likes of your group and other lenders in the marketplace. So that's not a business plug. It's just saying, look, come to us because you're going to get a better deal. John, do you have any views on the lending over the next 2 years?
Not particularly, but it happens.
Happy days. Perfect. Right. Let's move on to the next question. Do you have any live ones in yet?
No, not yet. Let's give another one to Tax John, because we know they're really interested in Dan.
Yeah.
Like Aiden's, I think Aiden's was quite a good one. And just a quick shout out to Harry Vakira from HV Financial. He came up at a recent event and really said how much he valued this. Anyway, back to you, Dan.
There you go. There's your plug, Harry. Thank you. Right, Aidan, thank you very much for this question. So, John, over to you, the wizard. I have a special interest in buy-to-let, the structure for holding property in limited company or other, because one size does not fit all, and limited company has a lot of drawbacks as well. Not least, living off rental income is not necessarily efficient through a limited company structure. And then the other big consideration is planning for inheritance of a portfolio without it being broken up overnight.
Cool. Second one's going to take quite a while. First part, right? It's too black and white to say a company has disadvantages, and I think I've been stressing this more or less since we started doing these. It's what are your client's circumstances, what are your customer circumstances, and what is the best structure for them, right? And if you go in with a sort of mental block on companies of, right, there's not a lot of advantages to them, then you actually are missing some opportunities. So where limited companies, as a rule of thumb, don't work or aren't particularly necessary, is that you own a property portfolio, and between you and your partner, your income is less than 50 grand before interest deductions. Yeah, because putting it into a limited company is just another level of administration you probably don't need. From a tax point of view, there is a commercial benefit in that companies have limited liability and you don't. So if something goes horribly wrong in your portfolio, you have unlimited liability. The company is limited to the value of its assets, equity. The other circumstance in which, from a tax point of view, companies generally don't work is where you extract all of the income to one or two, sometimes two, generally one individual. So if you're thinking that you've got a portfolio and you're a high rate taxpayer, I'll put it all into a limited company and then I'll just extract it all via dividend, you're not actually any better off. If you're a top rate taxpayer, you're actually slightly worse off, because you factor in corporation tax, which is a charge on the rents, then you take it out as dividend, and you end up, very broadly speaking, paying the same amount of tax. And that's deliberate. The revenue have structured the system so that salaries or rental profits and corporation tax plus dividends on the same amount end up with them getting the same net take. Right. Where a company comes into its own is that it puts a barrier between you and the money, you and your rental income. Okay? So there are two broad advantages. Three, actually. One, if you don't take all the money out, then you're only paying tax at 19%. And there are certain people, or there are people who don't need all the money out. There are certainly people who are building property portfolios who are leaving a lot of the money in. And if they were paying 40%, it's going to take them much longer to build that portfolio. because they're losing twice the amount of tax. There are certain people who are retiring and don't need the level of income and actually want to leave the portfolio to the next generation. Yeah.
Yeah.
It's very, very much dependent on your circumstances. It could be as a single property portfolio owner that you are earning a salary and your rent is getting stacked on top and you're paying 40, or you're in that horrible bit above 100 grand where you start paying actually 60% tax, right?
Yeah.
But you set up a company and then you can split that income with your spouse. And then all of a sudden your tax rate drops. Yeah. Now you can do property transfers and then that's fine. You can do it in your own name, that kind of thing. The other benefit is in your own hands, property income doesn't qualify for pension contributions, right? Now, if you have surplus cash, and I know property owners tend to like property, but pensions are a useful planning tool. They're free from inheritance tax. They can be invested in a range of assets, including commercial property with the right to pension. Yeah. And the pension contribution is corporation tax deductible and not taxable on you. So the use of a company, if you have surplus cash, is really beneficial in those circumstances. So it's always, and I can't emphasize enough, always down to the individual circumstances as to whether a company is useful or not. It's not a question of whether they have disadvantages and that kind of thing. It's what is the best circumstance for the in the circumstances. What is the best structure in the circumstances? Sorry. Now moving on to inheritance tax. Property, I think anybody who's in property knows this. Property is rubbish from an inheritance tax point of view. Yeah.
Yeah.
It is always taxable. It is always subject to inheritance tax. And you need to start planning early if you want to build a portfolio and pass it on. Okay. Now, a commonly used structure is something called a family investment company. And I'll try and explain it, so stay with me. A company, the ownership of a company is represented by shares, and shares have three rights. They have a right to vote, which is control of the company. They have a right to a dividend stream, which is the income from the company. And they have the right to the value of what the company owns. So if the company is ever sold or wound up, the value of that company gets returned to the shareholders. And under corporate law, you can split those three rights any which way you like. So you can have some shares holding the votes. You can have some shares holding the income rights. And you can have some shares holding the capital rights. So let's say we're building a property portfolio, but we've got surplus, we've got other income and we've got a pension and we're fine, right? So we are just building a property portfolio for the benefit of our kids. You can set up a company whereby you own an A class of share, and that gives you the rights to vote, and it gives you a discretionary dividend, which you control. So you control the company and you can take an income from the company. You can have a B class of share that goes to your kids. And that has the rights to the growth in the value of your property portfolio. And you can also add a discretionary dividend. And you can put those shares into a trust, of which you are the trustee. So you can control the asset, you can control the income. Through the use of the trust, you can move dividends into the trust and control that income as well. But all the growth in value in that portfolio goes to your kids, not you, and therefore falls outside of your estate for inheritance tax purposes. Another variant on that theme
is you may decide, right, I'll transfer in my entire property portfolio, okay, to a company. You calculate the capital gains tax, you calculate your stamp duty exposure. There may not be some because you might have transferred from a partnership and there's reliefs available. It may be that actually, so we're talking, say we transfer in a lot of equity and that results, you might be able to claim incorporation relief. We've talked about that earlier. I won't go on about that now because there's a lot going on here, which means there's no capital gains tax. Or you might decide, I'll pay the capital gains tax, which is a 20% rate, a 28% rate of tax it would be, but that's only on your gain. And it might be that it leaves you with a great big loan owed to you, which you can then draw down tax-free. And you might otherwise be able to have 40 or a 45% taxpayer. Okay? The company at that point is worth nothing. Properties have gone in with a value of, say, 2 million, but there's a loan owed to you of 2 million, right? So you've got this loan owed to you, and then you can do the same structure. I'm entitled to the current value. My kids or the trust are entitled to the future value. So all the growth falls outside your estate. If you need a big lump of money, you've got your loan you can draw down on. If you don't need that money, you can transfer that loan to your kids. And unlike property, there's no capital gains tax on that loan. So with inheritance tax, more than probably any other area, but with inheritance tax, there are very much circumstances and situations where you can plan to move the property portfolio without breaking it up, which I know is kind of like, you know, the golden goose of the property market. It doesn't work in all circumstances, but it's not hopeless. And there are plenty of times it can work. But you do need to know the full details of each individual circumstance. And I'm sorry if that was really complicated and I went on too long.
No, John, that was really interesting, and I made a lot of notes there because I could see the value of that. Something I could do for, say, Dan. But let me just get my head around a family ownership company,
family investment company.
Family investment company.
Yeah.
Would a lender? Would a lender see that just like an SPV? In reality, does it look and talk like an SPV?
There's no difference between that type of company and any other company. It's a limited company.
So just to be clear, because for all the guys listening out there who've got customers and are talking to customers, you could set up a family investment company that as far as precise Kent Reliance or InterBay would see as a limited company SPV.
Yeah.
You could then discuss with the customers regarding their shares and B shares. So for instance, if Dan set one up, Dan's daughter could have the B shares. We don't mind as precise a Kent, as long as they're under the age of, say, 18 or 21, how many shareholders of the directors' children. So we do see that a lot. So it's a family investment company. And just go back to the other point was, if I've got a limited company SPV and making profits, if that holds buy to let, I can take those profits and put it into a pension. And I can't do that in personal names.
No, you can't. So when you make a personal pension contribution, it has got to come out of salary or effectively trading income. It can't come from investment assets.
Yeah.
Whereas actually, if you've got your investment business, the property business, in a company can make contributions on behalf of its directors.
Even if that's just like an arm's length, it's managed by a letting agent, but I'm not actually running it myself. We can still do it.
There's the minor risk there. So it is a minor risk, and I've never seen the revenue actually take the point. You get your corporate tax deduction on the basis that it is for the benefit of the business.
Yeah.
Right. So if you're doing absolutely nothing, why would a business make the contribution?
Yeah.
To be honest, even a passive landlord is still undertaking work in a limited company. So generally, I've not had the revenue kickback on a pension contribution from any limited company, but that is a minor issue to be aware of.
just as a good, John, this is brilliant. Lee de Silva, Lee, apologise, it's my eyes. Leo de Silva has made a correct question. Does the family investment company need to have property investment SIC codes? So this is a question. So when you're forming the limited company, would the SIC codes that you attribute to a family investment company, does it matter what SIC codes?
Now, when you're dealing with the revenue, the SIC codes, they very, very occasionally pull up on SIC codes. Tax is all about the substance of what's going on.
Right.
Okay. So they may look to a SIC code as a form of evidence to support the substance.
Yeah.
If the business is a property investment business and you've got an incorrect SIC code, right? So long as you can demonstrate you've got a property investment business,
yeah,
it doesn't really matter.
So like with Precise, where we say we're like 68100, just try to remember the SIC codes, I should know them off by heart. So we come, let's say if I contracted you as a customer, because we have a question in from Ian Clark. Good morning, Ian. And John will give you his details afterwards, and we can't recommend John. But John, if like Ian was coming to you, I was coming to you, you'd set up a limited company, you'd have one of the standard 2 or 3 SIC codes that the lenders would have.
Can I just pull on this point as well? I mean, it's something that it's a little bugbear of mine, right? Because I've been dealing with the property business for quite some time now, right?
Yeah.
And there's a lot of landlords and brokers who come to me and say SPV, right?
Yeah.
And some special vehicle and something like that, right?
Yeah.
And SPV, a special purpose vehicle, is a company.
Yeah.
Or a partnership.
Yeah.
Right. In the UK, there are 3 types of company, and everybody here,
yeah,
will only use one of them. Doesn't matter what they do, what they call it, how they change it.
Yeah.
A company limited by shares. A company limited by shares is a family investment company. It's an SPV. It's a subsidiary. It's a parent, right? There is only one company structure in the UK. So when people are trying to blind people out there with science about SPVs, forgive me, it's bullshit. It purely is. It is just a limited company. The only other 2 types of limited companies are listed PLCs.
Yeah.
And that means the shares are available on a public market.
Yeah.
And companies limited by guarantee, which are used for not-for-profit organisations like sports clubs.
Yeah.
Everything else is just fluff around the fact that it's a company limited by shares.
So you would set up for me, if I paid you a company limited by shares, it would have, say, 68100 if I asked for, because with Precise, other lenders are available. Yeah. We would only allow 68100, 68200, and 68320. So you could put those on, and within the articles of association would structure everything that you've talked about. So guys, I hope you made that clear. Ian, I know it's made it clear for me, and good morning again, Ian. There's a couple of the questions we had, Dan.
Yeah. I mean, I can tell John's passionate about that there, and I'm glad you got that off your chest, John. So thank you. Hopefully you feel better now.
Still got it off my chest.
I mean, Glenn Lewis, sorry, Dan. Glenn Lewis says, wow, John McCaffery is a tax genius. Am I right in thinking he only covers England? If he does, if so does he have any clever tax advisors in Wales? So good morning. Obviously, Glenn, you must be in Wales, particularly with the name Lewis. John, have you got an answer for that? But
I do. I say I only cover England. The only real difference is there is a marginal difference between the UK and Scotland on the rate of income tax. And each of the various nations of the UK has its own rights over the equivalent of stamp duty, land tax. All of the taxes within the UK are the same. So income tax, capital gains tax, inheritance tax are all treated the same. The other minor difference, there is a tiny corporate difference on Scottish limited partnerships. But I can advise nationwide, except on effectively stamp duty in Wales and Scotland.
There you go, Glenn. John will give you his details afterwards. Jan, Dan, back to you. That was brilliant.
Yeah, no, thank you very much for that. So yeah, by all means, reach out to John after this. We will send John's contact details, as he is forever popular, and a great asset for this. So we'll go up to, I suppose, a lending question, which is coming from Ian Clark. So thank you, Ian. So Dan and Roger, in brackets, sorry, John, even though I know you'll have a view on this, I imagine. Do you think property investors should be looking at taking advantage of the more flexible permitted development right changes brought in beginning of August? Rog, what are your thoughts on that?
Yeah, I mean, I'm somebody who does take advantage of permitted development rights. Now, permitted development rights sometimes can be just how you vary your tenancy. So let's just say I have a house in Stockton-on-Tees and I want to put in 3 students in a 2-bedroomed house. I can do that under permitted development rights. So that's the first thing. It doesn't just cover structural changes, it can cover literally planning changes. But when it comes to the new relaxed rules, remember when you're doing things like converting property for flats, there's now a minimum floor square footage recommended around 39.5 square meters. So you can't do the studio flats of 30 below now. There's those minimum standards to ensure that the rooms are light and airy and helpful. And I know the Crystal Specialist team can really help you. Dan's quite an expert on permitted development rights, and I know Joe and the rest of the team are as well. But it's about how we're going to convert our high street, how we're going to convert semi-commercial properties. So if you've got a semi-commercial, the downstairs is on the high street, the upstairs is flats, and it says, do you know what? We can convert downstairs into residential. They will be well supported by the local council and authority, and it makes a lot of sense. It's about, look, but the only caveat I would give you right now, and I'm experiencing this on 2 projects, is 1, how quickly will you get hold of the tradespeople? And 2, can you actually work out a true schedule of works costings? Because on a recent re-roof that I did, I had roofing slats move from about 25 pence to £1 each, and a bag of cement was just going up when it was being transferred from the builders merchants to where we were. So you've really got to make sure you are absolutely confident at the cost of your works and getting your builders before you start, because Dan could arrange you a loan, do it under permitted development rights, but you've shot your profit before you've actually even put a screw in the wall, Dan. That's what I would say, but definitely something to look at.
Yeah, do you know, you raised some very good points there, because you're hearing all these tradespeople, which 1, can't get hold of supplies, or 2, do you know what, supplies are through the roof, and people are stockpiling wood and things like that because it's so hard to get hold of, and it's going up in price like bloody gold. So I think you do need to get some serious costings and need to make sure, if you are doing the conversions and doing the works and turning it to residential, yeah, 1, you're helping the housing crisis, which is brilliant, but I think you need to make sure you are getting the capital growth there, because I think if you can get a good deal and you can get a good price in terms of the conversion, regardless of the relaxation of the planning, etc., I think you just need to make sure that it is worth your time and you're going to get the capital growth that you want, because otherwise it's going to cause you headaches. There may be things that haven't been thought of that crop up. As with every development, nothing goes smoothly, something's going to happen. And yes, I do think there's some definite benefits there, but I also think that people need to be cautious. And if you are doing this as your first scheme, whether it's yourselves as a broker, if you've got a portfolio or a client, they just need to be aware and have a decent team around them that can do the works, because that's the difference between it going to plan and them making money, or actually them being in a bottomless pit and ending up having an asset there which they've put far too much money in.
Dan, we've got a question in from John Braden, which I'm going to give to you, and I'll happily come back. Was if clients purchase a property with a current value, say 150 grand, but manage to get it below that at 125,000 for refurbishment, what value will bridging companies lend on? Do you want to answer it first? I'll give it, and then John may have an answer.
Yeah, absolutely. Well, that's a below market value purchase, so we can lend on the current market value at a set LTV of say 70%. So if they're getting that's 10, that's about 15% discount on the property, if my maths is right, probably not, then they might only have to put in 15% themselves rather than the full 30% deposit, which is standard for the majority of lenders out there. So there are lenders out there that will lend on the actual market value as opposed to the actual purchase price. So you'll go to auction, you might get it for, I don't know, say £100,000, and the market value could be 150, but ultimately you're the highest bidder there, so you win it. So we can lend against the actual true value of that asset as opposed to the purchase price, and that's fine. Now the lenders that will do that, that'll lend against the actual value rather than purchase price, you're not going to get the best rate out there in the market because you're getting compensated with a higher rate for you putting less money into that transaction. So the answer is purchase price, we can do it. So yeah, and we're seeing a lot of people where, as it stands, they're purchasing a property that could be 70% of the actual market value. They're going to a bridging lender that will actually lend them 100% of that property purchase price. So in theory, because there's that 30% equity there, or difference in terms of value versus purchase price, they're not physically putting any money in themselves for the capital deposit. So the only thing that they're paying for is obviously the valuation fees, which there's no way to get around, and then the legal fees. So essentially you could be purchasing a £200,000-400,000 property and it could cost you £2,000 or £3,000. Now the chances of getting that is going to be pretty slim and on, because there's always going to be someone else there that could be bidding against you, but it is possible to not have to put any physical cash down into that sort of transaction. My only caveat on that would be is it has to be a property that has decent resale value. So it could be a 4-bed detached, 3-bed semi, whatever that is. We've had one sent to us recently, which was a £10 million townhouse in London that was actually getting purchased for 6.5 million. So straight away they thought, well, what I'll do is I'll purchase it, I'll do a below market value bridge, I'll buy the asset without putting any physical money in, then I'll refinance it to hopefully a buy to let at 75%. I've got a £10 million house, I've got £1 million in the bank for free. It doesn't work like that. Unfortunately, otherwise I'd be doing it. But to answer the question, yes, we can do it on the actual market value as opposed to purchase price. Rog, your views?
Yeah, just another, I mean, with precise, again, subject to the right property, what Dan's suggesting is right, but just something that I would also look at, and this is what I personally do, you can use Precise's refurb buy to let. So just say you buy it at 125, we'll value it at 125 and we'll give you a bridge on that. But at the same point, Dan will give you a val at the 150 once the property's refurbished, and we'll go to 80% of that. So that means you would get a mortgage of £120,000 on the 150, and you could draw that down a month after completion if the refurbish is done. So in effect, you've just about got all your cash out of the property. It was 125, but you'd certainly got a 120 loan, which would maybe help you get as close to what you want to do. So refurb, buy to let, or bridging, Crystal could speak to, which is a great point. Can I just ask John, there's a lot of people on the chat facility, on texts and on emails saying to me, I want to speak to John McCaffery. So John, you haven't got a banner up behind me. I know the process of getting one. So could you slowly read out your email address and contact number that people listening in today, if they wish, will contact you?
No worries. So there's a general contact number. I'll do both. And a general email. The website is www.alexander, alexander.co.uk. On there, you will find all our details. There's a bunch of property pages. There is a contact form, and there is my personal details on there. That's the easiest way to get through, right? Now, I can see my name has come up. I don't know if the panelists can see the name as well. If they can, right, my email is John, JOHNM, @alexander.co.uk. And my general contact is my mobile, but I'm not giving that to 100 people at the moment.
Don't blame me, John.
So people want to email me, and I will certainly follow up on those emails. And if they want to come through the website, I will certainly do that. And if it's not me, I've got a decent team out there who will most certainly be able to help them out.
what I'd mention is after this, we'll send an email with John's contact details, not his mobile number, out by your email with everything else. So yeah, do get in touch. But if you are speaking to the Alexander's office and you're not speaking to John, just mention that it's a referral in from John or whatever that may be.
There is when if you do speak to the office, and there is an option within our contact department to it be directed to a particular partner, so you can ask for me.
But the one thing I would say, Dan, thank you. On behalf of all the brokers who've registered, the value that you bring in this webinar isn't just focused on Crystal. It's not a selfish webinar. It shows the width and breadth that Crystal offer, supporting brokers by bringing experts. Other tax advisors are available. Neither of us are recommending, John. It's down to you to do your own research, guys. We got to and sort of enforce that. But we have loads of more questions for the next webinar. But it was just about trying to keep it at the hour, Dan, wasn't it? Which is a bit, though. There's a lot more questions coming through at the moment. Or they're being at work.
No, they are now. They are now. I think we've got one last one there in the Q&A, which I can't really cover off because I need a little bit more information. Gerald, thank you for the question. It says, have you any lenders who can lend to someone living in the UK and is paid in euros? Potentially, it depends on what the property type is. Is it residential? Is it buy-to-let? What they're looking to do, LTVs, etc. So if we could pick that up after and have a proper conversation, then that would be brilliant. I'm conscious that we've got quite a few that are unanswered that are in the pre-asked questions. So, for example, Derek Compton, we've got one from yourself. Ian Wallace, we've got one from yourself and a few of the other guys. So we'll pick these up separately with you afterwards, and we'll give you a call and just run through the questions with you in a little bit more detail, because we always like to stick to an hour. An hour is long enough to take up your valuable time. And that's it, really. So I think, first and foremost, thank you very much for joining. Do you know what? As you've noticed, we don't do any plugs for Crystal, any plugs for the One Savings Bank Group. We do plug John, but that's because he's brilliant at what he does. Again, we don't work with John, if I'm honest with you. So if you send business to him, we've mentioned previously, we don't get a kickback or anything like that. It's purely because he is genuinely the best at what he does. And you come off this thinking, wow, mind blown. So please do get in touch with John if you've got any tax questions. Again, if you want to speak to me or my team, please get in touch and we can help you place cases and discuss solutions for clients. Obviously, keep speaking to Roger's team around the One Savings Bank Group products, unless you want to deal with us direct. And I think the most important thing in the unsung hero to discuss today is Dave, our head of marketing, who arranges these events and makes them possible, because us three wouldn't have a cat and nails chance of doing that. He sends some brilliant emails, does some brilliant follow-ups, and makes sure these are possible and run smoothly and there's no technical issues. So thank you very much for that, Dave. But yeah, for me, another great session. We'll be returning on Thursday, the 21st of October for the next episode, which is episode number 7. And then we'll be having, hopefully, a Christmas special after that, which will be quite interesting. We'll see John dressed up as Santa and me and Roger will be his little elves. So yeah, but gents, thank you very much. Do you want to have anything else to say before we close this off?
No, again, thank you for the opportunity. It gets me very big audience, and I do reiterate, I don't really work with the chaps on they're not allowed to particularly, but I'm more than happy to keep doing this, and I think they're useful. I enjoy them. Thank you.
John, my 2 takeaways was family ownership, family investment company. And I'm going to ask you to repeat that, I think, on the next webinar, because I think, like, I live and breathe limited companies, and I wouldn't mind just a quick refresher of that and intercompany loans, because they're the 2 most common questions I get on a regular bit. And just remember, family investment companies are just a standard limited company that we will be able to deal with within our group of companies, as will Dan do. And thank you, everybody. Thank you, Alistair Comer and Andrew Forsey and Aidan Mustafa and Derek Compton and Ian Wallace, John Green, Macaulay Semple. Thank you to everybody else who's emailed in, Harry from HV Finance and my best mate, Rory. There's just so many, and a big thanks to Dave in marketing, who is got a face for radio. That's why we don't see him. He is a wizard with marketing. So Dan, take us to the end now.
Yeah, the end is near, but no, that's it. Thank you very much. Please do join us for the next one, because again, we can't do these without you. You've got some great traction. We've got a great panel, especially the wizards. So honestly, please come up the next one, ask the questions, learn and build some great relationships. But that's it from us. Have a great day. Get in touch if you need to, and stay safe. Thank you all. Bye-bye.